So, angel investment basics. A few words about me. I'm a full-time angel investor right now. I was running Telegroup about 20 years, sold it twice, once to Telia and second time to the co-founder. And since selling the Telegroup, I'm now full-time investor. So today I'm involved with ESPAN. I'm ESPAN board member and president. Then I have kind of small family hedge fund, Romivo, and I'm also venture partner in Superhero Capital, which is Finnish VC. I wrote a book about management and leadership. Unfortunately, it's only in Estonian. I have one copy of the book here on the table. So it's about how to grow the company and about the company culture. And there are a few of my invested startups listed on the screen and some failed investments, of which I think 3 are in a limbo state, so they still exist, but I have kind of written off them from my balance sheet. So, what we are going to speak today is what, why, and how to angel invest, and then a little bit deeper about how to evaluate startups and how to make the actual investment. So, what is angel investing? It's still important, I think, to have the common understanding what is the startup. Startup has 3 essential things to be a startup. It's to have a scalable business model, fast growth, and exit. So it's actually what all the startups are looking for. And why is that? It's because the venture capitalists, the VC funds, the professional startup investors, they are looking exactly for that kind of companies that can find scalable business model, that can grow fast, and that can exit, or that will exit. Startup investing is exit business, so you have to exit. Funds that invest the startups, they also have to exit. Typically, there are very, very few evergreen funds. And the typical term is like 10 years and then additional 2 years for exiting the remains of the portfolio. So, and what often is discussed is why the investors pay such a high valuations. I mean, the startups, 2 founders and 2 slides of PowerPoint raises money like with valuations of millions. So how this can happen overall? And the reason is that investors are paying for the future value of the company. So they believe in the startup and therefore they are ready to pay unimaginable valuations for the company. Startup investing goes in different stages. So angels are in the same region with friends and family and fools, FFF. You have heard this probably. And incubators, accelerators, and in the same level, more or less, with crowdfunding. But usually most often before the venture capitalists, before the fund invests. So it means actually seed and pre-seed rounds typically. A round valuations are so high that typical angel just doesn't have enough money to invest together with the funds. Of course, there are kind of super angels that are actually investing like a fund, so their tickets are in hundreds of thousands up to maybe few millions, but these are really rare exceptions. So from this slide you can see actually that it's really important that angels exist. They kind of make the startups happen for the VCs. So if there were no angels, VCs couldn't invest. So it's really important ecosystem player. Let's dig into the returns of the startup investments. This table or graph is from VC. It's very difficult to get any data about the angel investment returns. You can find some data about how individual investors have invested, but combined data is hard to obtain. So therefore, let's see the VC investments, and bear in mind that startup investments made by angels are far more riskier. So they have even less success than VCs have. So mean is 1.31, which means that invested euro or dollar brought back €1 and 31 cents in, let's say, about 70% of the VCs that invested. Yes?
In several years or several?
Yeah, it's exits.
Okay, so
Yeah. So yeah. Over the years, yes. Yes.
Let's say 10 years or something like that.
Yeah, yeah. It's the return, all exited startups that these VCs have done.
This is average.
Each like tulp, yeah, I know in English, represents one VC, and it's about 100 here.
So revenue was figure mean 1.31 is average actually per calculated average.
It's mean. It's not average. It's mean, and there's little difference in between average and mean. So you can see that worst funds even didn't return the invested capital. Half of the funds, roughly, didn't return the invested capital, and let's say first 6 or 7 returned 3 times the investment. Yes?
But is it already excluding funds fee for LPs?
It's returned to the LPs. Yeah. So let's go to the next slide, which is even more interesting, which consists of 2 parts. Here you see the number of deals done and how big return it gave. And the right part of the slides is share of the fund's return. Here we can see that even the most successful funds fail with up to 40–50% of the investments. And that's very important takeoff, that it's never possible to say which startup is successful. It's just impossible. Because if the most successful funds knew which ones are good investments, they would only make good investments. and about 18% of the really best investments return 90% of the money. Actually, we can say Pareto principle works here as well. So now here is the question: how to make investments, how to make profitable investments. But before going to that, why angel investing overall? Why do I angel invest? Of course, every angel may have different reason for investing, but we can say that the most common angel investing reasons are to give back to the community. So I was successful, I earned a big chunk of money, and I would like to give back something. I would like to see future entrepreneurs growing, and I want to help them. So it's also a good way to learn yourself. For example, if you are related to, let's say, metal industry, you would like to make investments into the metal working companies. So then you are like informed what comes next, and why not, you can maybe buy one of those startups later on. Its huge value is in the network that you create with your fellow investors and also with the startups. And also, last but not least, make money. So you hope to get good return of your investments. How to angel invest? The most important thing, as we showed with a few graphs, that it's extremely risky asset class. So if you think about your whole portfolio, like let's say it's like 1 million euros, for example, and let's just imagine you invest into the stock market, the public stock market. So you buy shares worth of 1 million euro, and then the stock drops and you lose 10%. So you are not maybe too disturbed about this. You think, okay, it will grow one day, so maybe I get back. But generally speaking, losing 10% of 1 million, it's not a big deal. So exactly the same way you have to think about the startup investments. Am I ready to lose this money? If you really cannot lose any money that you invest, don't invest into the startups, because you will lose some money for sure. Of course, there are exceptions. I know one person who made the first investment, and this returned about 10 times. He earned several millions, so he was lucky one. And he's not making any more investments. But these are exceptions. Same way as you can buy the first lottery ticket ever and you can win million. But it doesn't mean it happens to you when you start investing into startups that you hit Bolt or TransferWise with the first investment. There are different approaches in how to invest startups in early stages. The 500 startups, Dave McClure had a strategy to make a lot of little bets into the startups. But here it's important that when you invest a young startup, they have to be able to execute using your money. If you just invest 5,000, this strategy doesn't work, because 5,000 doesn't help any startup. They spend it in maybe a few weeks, maybe in 1 month, and then they are even in worse condition, because probably because they spent the money and there are some expectations. So, and with that strategy, it's important to double up the best, because you really like spray and pray. and then you just double up the best and get your returns through that. And if we saw that in the previous graphs that if you make 100 investments, so about very few, maybe 1, 2, 3, 4% of these startups return more than 10%. So you have to hit these startups which return that much, which means that you have to make that many investments that the statistics starts working. The other approach is to invest a lot of time, make proper due diligence, understand everything that startup does, and that way reduce the risks and make fewer bets. That would work as well, because there is clear correlation between making proper due diligence and outcome of the startup results or success. So it works, but now if you are going to build a portfolio of 30 investments, then how much time you have to do all these due diligences, etc. So you have to understand this and balance between using your time and making the investments. Quite a good strategy is actually follow the lead. It's actually exactly how it works for the crowdfunding. In crowdfunding, there is always a lead who invests his own money, and you just follow him. You don't do any due diligence, maybe spend, I don't know, few minutes up to maybe 1 hour to understand what's the business all about, and then you just follow the lead, throw your money. You believe that this lead has done the homework. It's also used in syndicates. Espan also does syndicates, so I will come back to this later. Hunting unicorn versus early mergers and acquisitions. With a strategy, if your strategy is to hunt unicorns, then be prepared to build a portfolio well more than 50 startups. Typical exit in Europe is 17 average exit, 17 million euros, 17, 18, somewhere in between. So there are some investors who don't hunt for unicorns. In Finland, we have historically 2 unicorns. One was this birdie game, Rovio, Angry Birds, yes. And the other one is Volt, now unicorn as well. So you can imagine how many VCs there are in Finland, how many investors there are in Finland, and they only have 2 unicorns. So it's really hard to hit the unicorn. So then there are some investors, also funds, who don't hunt the unicorns. They look for the companies that have highest probability for kind of 20 million exit. One of these funds that has this strategy is Gorilla Capital, run by Petri Lehmuskoski. But what is common to all of those strategies is the portfolio strategy. You have to build a portfolio. Don't make just one investment because it's most probably waste of money. But if you can actually also, I know people who have made only one investment, but they are not making this investment to invest from their invested capital, but they are making this investment to learn from the process, to support the startup, whatever reason. So they don't even intend to get the invested money back. So in this case, it's perfectly okay. So it's your free will and decision. Success and failures. So as we saw, there are about 1 to 2 great successes for about like 100 investments, I mean unicorns that you're gonna hit, and about 10% of 100 invested startups will return reasonably. So how I work, so I probably invest into a tenth of every startup I see. So that's the deal flow. I get 100 startups, and from that I choose maybe 10 or less. So as we saw from these graphs, it's nearly impossible to pinpoint a startup that will succeed. It's possible to reduce the risk of non-succeeding, but it's impossible to show the startup that will succeed for sure. It just doesn't happen. But it is quite possible to tell which startup does not succeed. So, and the strategy is better when your strategy becomes better and better if you can use this exclusion technique. Yeah. So, okay, this startup has this problem, I exclude it, and this startup has this problem, I will exclude it. But you have to bear this also in mind that no startup is perfect. They always have some things that need some attention. And that's why the investors are needed overall. If there is a company that has everything perfect, so they don't need investment. They don't ask for your money. So with the money, you can fix all problems, more or less. And also that more failures are in early stages than later stages. Also, one important thing or conclusion from these graphs that we saw is that never blame the lead investor, because it's like written, it's sure that he will fail in a majority of the investments. So it's just the hard work that the lead investor does in selecting startups, screening startups, and making the due diligence and taking the risk of losing his personal, social capital when offering these startups to the other investors for making the investment. But if you look at statistically, so then every lead investor will fail, at least half of the cases. So don't get personal here. It's just business. They do the hard work and just accept it. The portfolio strategy. So a good portfolio should have at least 20 to 50 investments. It can be distributed in time. I mean, let's say I would like to make 20 investments in 10 years, 2 investments per year. I use 20% of my yearly income, which is perfectly okay. Yeah, it's a small amount. And I do it in 10 years, and then another 10 years, and in 20 years I'm more or less out of the investments, hopefully with a good exits. Let's bring an example. If you make investments like 10,000 euros into every startup, and you would like to build the portfolio of 30 investments, it means 300,000 together. Yeah, let's just imagine we do it in 1 year. So, which means your total wealth must be maybe 5 times, maybe 10 times bigger, like 1.5 to 3 million. And then, as that early investments that angels do are much more riskier, it makes a lot of sense to do follow-up investments into, let's say, roughly about third of your portfolio, and triple that money, because the valuations go up during the growth of the startup, and if the startup was successful in the second round, for sure the value is higher, maybe 2 times, maybe 5 times. So to get the same shareholding that you got in the first round, you have to invest more. Let's say you put 30K into every third startup of your portfolio of 30 companies, so you end up investing 30K into 10 companies, which actually makes, if that is now 10 or 20% of your total portfolio, then this means that your total wealth must be somewhere around 3 to 6 million, which is a lot of money, of course. The strategies may differ, of course. If person is younger, let's say in 20s maybe, he can invest more, because more from his total wealth, because he's a young guy and he has some work, gets paid for the everyday work, so he will earn some money in the future, so it doesn't matter if he loses maybe half of the portfolio. It doesn't matter, of course, or it doesn't mean that when you invest into startups that you lose everything. You may lose everything. Most probably you don't lose everything. You get something back. And from this previous graph, from the VC investments, we saw that the mean is 1.3, so you get at least the invested capital back. Okay, how to make syndicates? Because why syndicates? If you invest only 10K into the startup, so what can they accomplish with only 10K? It only lasts maybe a month, maybe 2, probably less. And then they are back in the same situation. So how it's good to look at the angel investment is that what is the risk I get off the table with my investment? If they just say, we hire 5 people and we do some Google ad, then it's a wrong answer. It's how you spend the money. I would like to know what are the risks you get off the table. Which risks less after you have spent my investment? So is it a product? What happened? Is it the product that you get ready kind of for the sales? Or is it the new market? So let's imagine you were in Estonian market and now you want to conquer the Finland. And so it must be something that you obtain with the investment, not just hiring like 5 guys and spending some money on Google ads. And to get a risk off the table, you need a decent amount of money, at least like 70K up to maybe 500,000 or a few millions. Depends on the startup and what they're doing. So when investing, you should understand that with the money they get from you and from other investors, they can accomplish something. So in Estban, we have two models of leading in syndicates. So the lead investor finds the deal and sends the email to all ESPAN members that I have this nice deal, I'm investing myself, and please join. And how to motivate the lead investor for the work he did is we have like kind of two typical models here, is the carry model or the discount. Discount means that when he invests 10K, he will get amount of shares that equals actually to 20K of investment. So gets a certain amount of discount. Or carry means that when startup is exited, first all the invested money is paid back to the investors, and then what remains is shared among the investors after taking away the carry. I'm not sure if I was clear enough here. So actually the carry is from the profits, like 20% or 15% from the profits, and then the remaining is distributed among the investors. Yes?
The first option, historically, do startups make this discount for lead investors, or do syndicate participating angels buying this half of the share for lead investor?
So the startup actually, it's actually, so you get, the lead investor gets more shares from the cap table for the less money. So it's stated in the documents, and what it does actually, it kind of dilutes all the other. So
But do startup give this?
yeah, startup gives this, yes. Yeah. All the money actually goes into the startup. So yeah, good. And ESPAN SPVs, few words about what is the SPV. SPV actually means special purpose vehicle. It's osaühing, limited company. And this osaühing, the limited company, is owned by ESPAN. ESPAN is non-profit. Non-profit can own a profit companies, for-profit companies, and then the SPV is managed by two persons, lead investor and ESPAN manager, who is currently Anu Oks. Yeah. and they manage this jointly. I mean, the problem here, not the problem, but why jointly, is we would like to reduce the risks for the investors. So if there is only one manager or board member for the SPV, then anything can happen to this board member. He can go nuts, or he can die, which may happen, and anything can happen. So if there are two board members, then the risks are much reduced. From the ESPAN point of view, this startup is represented, or how do I say it correctly? So the üldkoosolek, the general meeting is the board members of, majority of board members of ESPAN. So, and these are rotating every 2 years. So therefore, it should be kind of safe for the investors, the SPV Oy, SPV Limited. All the bookkeeping costs for the SPV are borne by the SPV itself, and also the legal costs and for that SPV takes only 2% of the total investment, the money invested by the investors. And for comparison, VCs take 2% roughly every year for the management. Not every year, but let's say the years, investment years, like first 4 to 6 years, they take 2%, and later they take less. Okay, and there are two important things for the SPV, why it's good to invest through the SPV. Although you pay a carry for the lead investor, I would say most important is that it protects the individual investment. So if you are the kind of first angel in a company that is really, really big, and he has like hit the point like, let's say like Taxify or Bolt was this year, that Corona just started, your revenue drops like 2 times, and then you have run out of money. So then you go to the big investors in London or Silicon Valley, and yeah, I would like to get some money. Would you invest? And then they say, okay, we're going to invest if the liquidation preference is 2, which actually means that the investor is getting back 2 times the invested money before anybody else is paid. But the startup is in the position where he has to take this money because, you know, they have maybe 400 employees, and they have no option, like shut down your company or take the money if they have no other options on the table. Even if the startup founders want to protect the early angels, it's very, very difficult for them. But now imagine if we have SPV that holds maybe 10% or maybe 15% before it's diluted. So it's a substantial amount of investment, and so we can speak on behalf of us. If you are just alone, so it's very easy like to forget you. There are cases in Estonia where like first investors have difficulties to get their money back even. Okay, so that's why SPV is actually good. And there is, yeah?
Would the SPV, representatives try to negotiate a better deal then, or?
Yes.
It's probably
Yes.
not going to be possible to raise more money by the angels because,
of course,
400
yeah.
employees and you survive another half a month, and that's.
Yeah, then they try to negotiate a better deal with the help of legal advisors. Yes?
When this fund is making an SPV for syndication, will this syndicate by default try to get a board placed?
No, no Espan syndicate has board seat.
Then how can we possibly affect the decisions?
It's like social pressure. Yeah. But I mean, finally it's important. I mean, if it's just one investor, nobody cares. Yeah. If it's 30, 50 investors, so their voice counts.
Much more social capital as
Yeah.
well to use.
Exactly. And then with the next investments, you know that there was this venture capital company that don't care about the angels. So guys, you can invest because we invested first.
But why do not we try to get a seat in the board? It's always good to have one, I mean.
Because no company we have invested with SPVs has board yet. It's probably not meaningful to make board before A round. Or, okay, it's meaningful to make it before A round, but not in the seed rounds, during the seed rounds. yeah, now here's the question: who manages the company? So, do you want to have the? Yeah, it's now there was two questions like the supervisory board member or management board member. So, and Estonian the SPVs we have invested the startups. No one of them have the supervisory board. So we cannot have the supervisory board seat. But having the board seat actually in the startup means that we should be like a founder.
Yes, we can participate in meetings and
also
it would be great if lead could do it actually. But okay,
and reverse vesting and all the yeah.
Board seat is a cost, I think, because the management board member legally it's liability in front of the shareholders, etc., and it takes time and effort and everything. And I think that this SPV is not ready to finance it, but probably this is something you should think in the future for larger projects. Yeah. Would you like to be the board?
I mean, I love to be the board member everywhere again. Like if I'm in with my money.
But it takes just time and effort.
Yes, sure, but I put my money. I want to put my time.
Yeah. But of course it depends probably.
I mean, as a lead, I would love to be.
If it's as a lead investor, yes, but again, it probably depends on the amount of investment.
Yes, but okay, I would also expect the lead of Syndicate I'm joining to be willing to take this position.
But it's a good idea. It can be additional.
Yeah, it can be good idea. Yeah.
You read about startup investing. If you only can get a board seat, get it. Always.
Yeah.
It's always great to have one.
It's good to get more information from the startup, but in terms of like managing the startup, I don't think it's good. It could be like viewing member, if that kind of term is, that you have a right to attend the meetings, but no voting right, nothing. That could make sense, but like having a ordinary management board member seat, I mean, then you have responsibility in running the company. So startup founders may feel one day that, okay, we have no ideas, so we are like, we would like to quit. Will you then run the company? So actually, who runs the company? So you have to, you have to build a portfolio of 30 companies. Can you be management board member for every 30 companies? Yeah, okay. Okay, so that much about Espan SPVs. Now, if you don't have like 3 to 6 million to spend or your total wealth, how to invest smaller? First, you can distribute it over time, like during 10 years. And you can also reduce the amounts, like make 1,000 up to 5,000 investments per startup using crowdfunding platforms. There it's perfectly great idea. You can probably attend some accelerators, invest into the accelerators. In Espan, we have kept the investing minimum in 5,000 euros. So, and why is that? Because we would like to keep the costs as minimal as possible. So that's why we have this 5,000 limit. And for sure, startup is an exit business. If the founders tell that they are building the like family business, they will never exit. So you as minority owner in the company, you will never get your profits, most probably. Or maybe you get something, but you don't get the return of your company, return of your investment. So there is trend. I didn't look for the graphs, but there is trend that time to exit is growing actually. So startups, it takes more time. All the existing funds will exit, and then it goes to, Pipedrive was bought by private equity actually, and many funds sold a great chunk of their ownership to the private equity. And what is also important for the angel investors, I think, that you should consider selling part of your investment in a successful startup before the actual exit. So make secondary. And why this is important? Because you never know if the exit is successful unless you have exited. Typical exit may be 5-10 times EBITDA. But the startups are invested we can say that if the startup lifetime revenue is, let's say, 50 million, they are probably invested 50 million. It's crazy valuations. So therefore, you'd never know what the exit brings you. You may even not earn anything from the exit, even if the company is really successful. So if there is someone who is coming to you and is willing to buy part of your shares, it's a good idea to sell at least that much that you get your initial investment back from the startup investment. So then everything that comes is extra. Evaluating startups, that's the interesting part now. So what is investable startup? Every company in the globe has 3 vital ingredients, I would say. It's the resources, its market, and its product. So if one is missing, the company cannot make profit, cannot be successful. So, and when the startup comes to you, they only have maybe 2 founders, 2 team members, no money, no product, no market, nothing. So what is the value of the startup? Nothing. But you will trust the founders, and you will invest some money and hope for future success. So you can even calculate this future probability of the success. And let's make kind of assumptions that we have startup who has, let's say, market and team and money and everything, but they have no product. So how this can happen is not important at the moment, but then if you Google how many products are successful, so you get the result that about half of the products fail. So whatever is produced in the globe, half of the products fail. So we can say the probability of getting the product, if you have the market and team and money and everything, is 0.5. Yeah, here we have 0.5. We can say more or less the same for the market. So let's imagine we have a company that has product that sells like hell in Estonia, and they have team, they have money, they have everything, but they do not have Finnish market. So let's go to Finland. And it's again like 50-50 probability that they will succeed in Finland. So 0.5 again. And then let's take the team and resources, money. So roughly we can say you invest into every 10th of the startup that you see, which actually means the probability of getting money which can pay or fix all the problems is 0.1. If we multiply all this, we get 0.025, which is effectively 2.5%, which is coincidentally also the number of unicorns per startups, per funded startups. Yeah. In Estonia, we have 5 unicorns and 1,000 startups. How many it does? It's 0.5. It's even less. Yeah, and it's extremely successful. Yeah, if you invested every startup in Estonia, you would have made 200 investments to get 1 unicorn. So, and we had assumptions that made this success formula much better. So what is GTM? It's a go-to-market strategy. What is PMF? It's product market fit. And IP is intellectual property. So it's good to bear in mind this kind of 3 ice balls when evaluating startup. So every investor has a list of no-goes when investing startups. So this is more or less my list. A lot of things are fixable, as I said before, because I have seen no startup that has everything in place. For example, quite often they do not have the agreements in place. So in the very early stage where risks are really, really high, it doesn't make sense maybe in the first investment to pay for the legal costs, which will be high probably. Then it's good to go with the Startup Estonia default documents, for example. And most often the startups that I see in the seed round, the first angel investment round, they don't have the documents in place. So I will say them, please take the documents from this resource and make sure everything is there. I will check it. Then it's of course good to also ask from some of our partners. Estban has many or few legal partners, and to ask from them that if there is something specific that needs to be fixed. So now the picture needs some fixing. We lost the picture. And here it is. I will stop on some of these things. For example, can the startup say with 1 sentence what they are doing? So if they continue explaining 5 minutes what they are doing, can you imagine if they can explain it to the customers who are supposed to pay for the service? So if they are not able to explain in 5 minutes, nobody will pay. If this business is scalable, even some non-scalable businesses could be scalable. You know, if I make a restaurant and I have discovered something nice like McDonald's burger, I can scale the business using franchise, for example. So small pivot could help. Big enough market, of course, company can become unicorn only if the market is big enough. If the company is valued like more than 1 billion, let's say the EBITDA is around maybe 10% finally, so you want to create a, you want to have an exit like more than 1 billion, then you can calculate how these numbers work. So the market should be big. Unit economics. There are very nice examples from famous startups where unit economics is not in place. I think one of these is Uber. So where the costs of acquiring the customer is actually higher than the revenue they get from customer. So what else? So why one solo founder is not good? Because humans are social animals, and if I'm like cut away from the others, like I'm only in my own thoughts, then my mind starts drifting and it drifts away from the reality. That's the common reason. So to run a successful business, I need to discuss with my co-founders. I have to friends around me. I have to have friends around me, and then good ideas come out. So it's nearly. I mean, if I just sit on the bench and start thinking of good ideas, the ideas don't happen like that. It's ideas come with a discussion with a co-founder. And cap table. Cap table is the ownership of the company. So if the cap table is spoiled, which means that let's say the first angel took like 40% of the equity, and then hopes that the startup will fly. So nobody else is joining when first angel has like 40% of the equity. But it can be fixed. Actually, the first angel has to be diluted, and then other investors can join. So this has happened as well with many startups, even famous startups in Estonia. Startup culture and process. This is a long and complicated story. That's what I have in my book about this startup culture. So the ideal founder has to be able to grow the company through the valley of death, like 15 employees, 50 employees, 150. Here we come to the Dunbar number. You can Google for it. It's an interesting way or theory how the human mind works. So we only have certain amount of people that fit into our head. I mean, the typical village in the globally is same size. There is only like less than 10 people who we really trust, and there is only a fixed amount of names that we can remember, no more. If we like learn new name, then somebody is lost. Yeah. So, and these are the stages actually that companies hit another wall. The certain number of people, and to get over it, you have to change the management. You have to change a little bit the culture and many more things. And typical failure that I've seen is that the founder becomes the bottleneck. Actually, he's like wants to be where every decision is made. He wants to take part of every decision, but the founder only has 24 hours in his day, and it's limited. His powers are limited. I mean, how much he can make good decisions. So he has to be able to grow with the company, and there are not many such people. Unit economics. It means that the lifetime value of the customer must be many times bigger than the costs of acquiring the customer. Again, there are big startups on the market that have raised a lot of money and have gone bust because it didn't work. The unit economics didn't work. So it's really important to look at that as well. But the problem here is that the stage where we are investing, you cannot calculate the unit economics. the early revenue actually doesn't matter at all. The product market fit that you achieve is not product market fit on another market or when you grow bigger. You have to constantly, or startups have to constantly find for product market fit. It's not that you achieved product market fit and you can relax. There is no such thing. So it's difficult to calculate the unit economics. Market potential, again, if you're hunting unicorns, then you should be sure that the potential market is big enough to help the company to grow. If you are not hunting unicorns, it can be less, of course. Ownership and cap table. So the rule of thumb is that founders plus ESOP, it's equity, I just forgot it. Employee share option plan, yes, thank you. Employee share option plans should be like majority after seed rounds. Like let's say in the range of 70 to 80%. So the seed round and the pre-seed round, the two first rounds that the angels do should end up with up to maybe 20%, 25% of ownership. Yes?
In your experience, how many of Estonian startups started a round having more than 70% of equity?
I haven't done this, but it's challenging.
Mostly, like what I see lately, they go to a round having something like between 50 and 60.
Yeah, they could be good like targets for mergers and acquisitions. For example, statistically, when startups list their shares, the owners and employees have somewhere in between 12 and 17% altogether. So not much. And actually, if you go to the A, B, C round, typically what investors expect is more than like 20% or of the round.
Thinking about like when I see a startup is pitching and they are preparing to a round and they need some maybe bridge financing where angels with angel type of tickets can still probably participate because obviously a round is not angel game. Like then what I typically see is like 70 to 80.
Yeah.
I would love to see, but I don't see it.
Yeah. What often is done in later rounds, if the startup is really successful, but the cap table is spoiled, which happens, you can give options to the founders and dilute all the other investors. And that's also what probably happens quite often. And the most important thing is the focus. So it's Eric Ries has said, startups do not starve, they drown. It means they have enough capital and they drown into this capital, more or less, doing too many things. To understand this, I bring you a good example. So if you would like to win the gold medal from every sports of Olympics, is it possible? It's impossible. But what could be possible is that you win a gold medal on certain sports. And that's what startups must do, actually. They should find out where is their strong where are the strong points and which is a field they are doing the best in the world, and then only doing that. It's exactly like Amazon did. So they became the #1 online bookseller, and then when they achieved this gold medal, they started going into adjacent industries. Few other things. Early revenue is good, but it doesn't mean there is product market fit. So we spoke about it a little bit. It's very the product market fit is something that is always constantly being sought for. So early successful exit is most often correlated with the luck. It's actually hard to find any other correlation here. And also the luck doesn't happen just without serious work. And the founders and the angels, why not, have to be open to find the luck, to accept it. There are always exceptions, so there is no perfect startup. If there is a perfect startup, then it's not a startup. They don't need your money. And now let's go into the funding of the startup. I have made a short table of the stages of the startup, the investment rounds, like pre-seed, seed. This is an ideal case that doesn't happen, but that's something that every investor looks for. So you can find the valuation, what is the investment amount, what's the monthly recurring growth, and monthly recurring revenue, and the years of the startup life. Most exits, of course, happen between 1 and 20 million. Companies are bought, not sold, so it must be some value to the buyer. My exits, everything under 20 million that I have had. And for the startup, it's hard to get anything done below 100K. Go to Change Ventures website. They have now nice new statistics out. I brought here some numbers about the round sizes and valuations. Of course, it's always question which round is pre-seed, which round is seed. So there is no definition of that anywhere. Yes, and angel investments are pretty small. You have to build a portfolio, and most angels have their kind of day job. They're not full-time investors, so they do not have time to make proper due diligence, and it's good to think about a good strategy that you do not spend too much time, but still you make wise decisions. And for the end, few words about terminology. I stop on few things that's often not really well known. Run rate. Here you have to understand for which period it is. Is it annualized? For example, annualized run rate is the revenue from, let's say, today, 1 year, all added up, revenue I'm expecting from now on, or for the financial year. What else? A lot of startups mess up with pre-money and post-money valuation. So post-money valuation is the valuation of the company after investment. Pre-money valuation of the company before the investment. In the agreements, if I'm not wrong, typically it's pre-money valuation.
I think traction is also like used so differently and understood so differently. So you say it's a customer interest in using products or services. Sometimes they say that traction is also revenue numbers.
Yeah, can be.
So yeah,
but
there's just different things that you can mention under traction.
Yes, but traction in the terms of.
Yeah.
Traction of what?
Because like for hardware, traction can be just development process.
Yeah, and what it was for the Twitter, which remained a long time pre-revenue company. So they just and also Google and also Facebook. So they were long time pre-revenue.
So what is the main traction that you are looking for?
Let's say, as I'm not really looking for unicorns, so I hope to get earlier exits. Like statistically, it's better than I'm looking for the monthly growth rate of customers or revenue. Runway time that's left until money runs out. Yeah, and this also takes into account the money that company itself earns, the startup. Liquidation preference, really important term. It's typical to give one-time liquidation preference in early stages, which means that if you invest like 1 million, in case of exit, you first get 1 million back if there is so much money on the table. And after that, the rest is shared like pro rata. And if there is a carry involved, then also carry is taken before. Convertible terms. Shall we go this through? Would be good. Okay. Valuation cap is the maximum valuation when what is convertible overall. Investor gives money as a loan to the startup with the option to convert at predefined event, right? And the valuation cap is the maximum valuation that the money is then converted. Yeah? Valuation floor is if the company don't reach the qualified financing. I mean, there is qualified financing. The next round is defined. Let's say they should have raised 1 million. If they don't reach this 1 million, then it's converted. The investment is converted using valuation floor, which is often startups don't pay attention to it because they hope for high valuations, and then reality kicks in, and they have to convert with valuation floor, which means that you get like a big chunk of equity for a small chunk of money, which is quite nice for the angel investors somehow, but we can also say that startup didn't meet the expectations. It's a bad investment. Discount is when the qualified financing happens below the valuation cap, then the investors get the discount of the valuation. So they get the investment cheaper than the other new investors. And sometimes interest rate also is applied to your money. These are the most important terms. There are many other things as well to pay attention to. But then it's maybe good to consult the legal advice. Yep, this is it. All from my side. Document drafts for startup investing you can find from Startup Estonia website, and I hope you enjoyed. Any questions?
Maybe you can also say a bit about safe agreements, just to cover.
Yeah, safe is similar to convertible, but it's much simpler and has less protection to the angel investors. It came from US. There are different versions of the safe as well. Now in Estonia we have also safe template. I don't know. It's good way to get fast money for the startup, and the level of trust to the startup founders must be a little bit higher than when using the convertible. But in essence, it's a convertible agreement.
What's the difference between safe and convertible?
You can answer it better, probably. Do you want to answer?
No, I haven't. Actually, in practice, coming from different, but I have not used safe at all, always convertible. And mostly we cannot use valuation cap and law as well, just discount and interest capitalized and convertible shareholding.
For convertibles?
Yes,
yeah.
Just convertibles. I normally do not use Startup Estonia blanks, but some other similar,
Yep.
but probably we have to use it. So just safe is a bit confusing. So, and maybe I thought that maybe you can also explain to the audiences.
Yeah.
Or I will do it.
Yeah. First from the investor's point of view, I would always use valuation cap, because so we are taking, as investors, we are taking the huge risk in very early stages, and then those professional investors come, and I only get like 20 or 30% discount. So why should I take higher risk and just get like 20 or 30% of discount? It doesn't just make sense for the investor. But of course, you have to see the terms in combination. So for the startup, why safe and convertible is that they grow so quickly, and raising money takes time. And let's say you raise money maybe half a year, but company can actually grow like 3 times during that period. So when first investors in this 6-month period come, and the last investors, why should they have similar terms? So it makes sense, to make convertible so you can play with the terms.
If I may add, there is the main essential difference between safe and convertible is safe by default does not have maturity date. So if liquidity event never happened, then the owner of the safe will just have a nice piece of paper on his or her phone.
So basically,
That's the main danger for investing.
Mm-hmm.
If startup will do so well, they will never need another investing. So
Yep.
your safe will never convert to anything.
And I've seen safes that didn't have also valuation cap. Now imagine the next round they raised like from the valuation of 1 billion. So you took all the risk and get so small amount of the equity. I've seen safes that didn't have discount or the cap.
What convertible and safe without valuation cap makes no sense.
Makes no sense, exactly, yes. Thank you.
Maybe a little easier question regards to the valuations. That if you participate in a pre-seed round and there is not a lot of angel investors around as well or participating yet, then how do you value the work of the company, or what is the logic, or
where you make decision what is
what is the valuation that makes sense? Because a lot of times it's just, come out of the pen and doesn't make sense. But from the company side or the owner side, you understand that they don't want to give away too much, but at the same time, yourself as well.
Yeah, I often follow this table more or less.
Mm-hmm.
There's still some negotiation, especially with evaluation, maybe you come from 1.1 to 900K or
Yep.
1.2 is too much, would you come to 1.2? Where do you get this feeling whether it's negotiable or not?
One of the good indicators is how long the startup have been raising money. So if they are doing it for, I don't know, 6 months already and nothing happens, so then probably the valuation is too high. So it should be lower. What else? Then it depends a little bit about what the business the startup is doing. What is the business? So for fintech, for future unicorns, the higher valuations are makes more sense. I mean, because there are other rounds that should fit in as well. Yes.
Also, maybe that's why convertible note is in cases like this is much better than equity investing, because you're just setting cap and floor, and you don't have to negotiate this 5% difference in valuation. Let next round decide the valuation.
Exactly. Yeah. But my personal preference is to make the first round equity investment. Because if it's convertible and the cap is too high, then again, why should I take this huge risk and help the startup to reduce the risks for the next investors and only getting 20% of discount for that? So that's why maybe the equity in the very first round is better, and with a seed round, startup already grows like hell, then the convertible is better.
Maybe in this case is to use non-dilutible shares up on this, let's say on the end of the seed round or something like that, based on the agreement.
Could be. It's non-standard, I would say. It's better to stick to really standard terms, because it makes easier for the next round to raise. I mean, if the terms are too complicated, so it will make more difficult raising the round. So I would keep as simple as possible, using as much standard document and everything standard as much as possible.
Me first. I have a
Sure.
No, actually, I just wanted to change the topic a bit and go just a few ideas or a few thoughts on angel investor ethics as well. What are the main things to bear in mind not to ruin from the angel side to startups?
So you're asking if what should angel investor not do?
Yeah, basically.
Cap table wise or
Even ethic-wise as well.
ethic-wise?
We've seen some cases, and maybe as we are talking about basics, maybe these are something to bring out.
No, I don't think there are big issues overall. So of course, startups have some trade secrets. So if angel invests into 2 startups that do this on the same market, so you have to be really disciplined not to leak any information. VCs typically avoid investing startups into the same industry where they already invested. So this is maybe the most important thing that startup investor has to bear in mind.
Maybe not to be, but not to take too much equity. Like just still bear in mind that your money might be so valuable for you, but to understand that in order for this startup to be very successful, you cannot take.
Yeah, but now it's a question of, is this startup? So do they need another round? If the startup doesn't need another round of investment, and let's say if the startup founder asks me, I don't know, 200,000, and I can easily see that they never need another investment, and they will become profitable already this year, for example, and he's ready to give 20%, of course I take it. No problem. But if the startup needs another investment, then the story is completely different. Then it's startup. So it's the growth model that has to be fueled with more and more money.
I also, before Lev takes it away, Pavel is asking from Zoom is that can you take a larger discount as well, like 50% discount?
But when? Or what's the context?
I don't know. Can you ask for a larger discount, like 50%?
Yeah, it's a free world. You can do anything.
You can ask everything.
You can ask everything, yes. Freedom of speech.
Yeah, I just wanted to, you asked about evaluation in the case there is no one but you and startup defining evaluation. Iva just said, first understand the case. If it's maybe the last investment round, then try to get as much equity as possible. But if it's typical investment, like angel investment, when you expect to have more rounds, then what defines, in my opinion, what defines valuation of startup is A, amount of money they need now to execute in this round, and B, reasonable amount of equity like the reason amount of equity that they should maximally give you or investors to still be investable for next rounds. Like angel investments, one of your obligations if you want to have more rounds for this startup, if it's not the case of last round, then you should keep this company as investable as possible for next guy. Like when you go in, you immediately start to work to make this company sexy for next guy, next round or girl.
Because the startup most probably in early stages doesn't have any profit. They burn all the money, and for the startup to exist overall, they need new investments. So that's the point here. If you make it non-investable with your investment, then actually you are throwing your money away.
Okay, if no more questions, let's wrap up.
Thank you very much.
Thank you. Okay, please grab some snacks and let's see you on the next episode.